It's taking a little longer. Is it affecting my?
Being live stream.
Hi.
Yeah. Cool.
Okay.
We're on.
We're live. We're actually live now. Man, it took us fast really to live. Yeah. Hi, everybody. Welcome to this edition of Beyond the Podcast. Taking a little longer. Is it affecting my? Hold on here a second. 1 second. Now I'm running two things at one time. There we go. We are just sitting here chatting before we went live. And, for those of you that go live, when you just go, you're on live. So you just have to, not start in your normal way. So that's exactly what we did. We were just talking about the devastating fires in Maui and all of that good stuff. So I want to welcome my guest today, Lane Kawaoka. He is the founder of the Wealth Elevator. I love the name of your company. And Lane was also a guest of ours in April. Actually, not April, March 17th on St. Patrick's Day is when we released your podcast, March 17th, 2022. So a year and a half ago. And the title, so that everybody knows, is Understanding Diversified Portfolio and Real Estate Investing. That was the name of the podcast. It was episode number 318. So now this is what we do. We bring everybody back about a year or so later and find out, what are you doing now? Where are you at now? That's why it's called Beyond the Podcast. So welcome to the show, Lane. We're just going to be at, 15 minutes max. How are you today?
Yeah, good. Thanks for having me. What's been new? Well, we rebranded the website because the new book is coming out, The Wealth Elevator. It'll be
nice.
So it'll be my second book. And I think the difference between this book compared to other books is there's not really anything out there for high net worth investors, people with mostly targeting accredited investors. And I really talk about like different paradigms in the wealth building journey. Like when I first started, I would buy little rental properties, when I was fresh out of college. And then when I became more of an accredited investor, started investing in private placements and syndications and started to implement all these tax strategies to use passive losses to knock out passive income and then maybe even ordinary income with real estate professional status on my taxes. But it's like the concept is like, you're trying to scale a building, right? And you have these floors. I think a lot of people talk about like the wealth building strategies when you don't have money, you're in credit card debt, that's kind of like the bottom, right. The bottom floor, right? And then what do you do when you have some cash, 20 grand, 30 grand to buy a rental property? That's kind of on the first floor. But then what do you do when you're an accredited investor and then, the higher rungs, and then you go to the penthouse level? I never had it explained to me that, it's not just one strategy, for everybody. It's based on where you're at in terms of net worth and income. Absolutely. And then how it kind of transitions, as you kind of grow up, right?
Yeah, I love that. Tell us a little bit about, so that's your new book that's coming out. Tell us about, and when is that coming out, by the way?
Oh, you know how it goes. Not a good idea yet. The idea is we're going to get this thing out before Thanksgiving so that when people are at home.
Good. Let me know if you need any testimonials in the book. I'd love to write a testimonial about it. Just send me a chapter or two. I do that a lot. I do a lot of forwards and testimonials in books.
Oh, thank you.
What was your first book? Remind us what your first book was.
My first book kind of just went over on my story. It was called The Journey to Simple Passive Cash Flow. That one's on iTunes. It was a real quick read. I think most people kind of was able to get through it in 5 to 6 hours real quick. But it was kind of centered around myself and the journey that I took, graduating college.
Right.
What I call the linear path for a lot of people, where we're all taught to go to school, study hard, save up your money, put it into the 401k to buy a lot of traditional investments. Exactly. Right. But I didn't know any better, right? Like when you're surrounded by, coworkers and parents, we're just kind of brainwashed to give her money to the institutions to invest her money and then buy a house to live in. But you know, very early on, I bought a house to live in and just started to rent it out, and that was kind of where I got to taste the cash flow. That was 2009, and then 2015, I had 11 rental properties, and then I pivoted from there into syndications and private placements in apartments and commercial buildings. So I'm kind of just going through my story, and then kind of sort of outlining the different levels that we talk about in the wealth elevator, but it wasn't
in the second book.
It wasn't as pronounced and defined as it is kind of now. We have graphs and flow charts and what you do for infinite banking, taxes. People want to have their 401ks, qualified retirement plans. I think in actuality, once you get to a higher net worth, that's when you start to do it. But that's kind of one of the things I talk about in the book. The frustrating things is most people, they start to fund their 401ks, Roth IRAs first, which I think is completely backwards. And unfortunately, when you do that, you never fill up your today cash flow bucket, and you never retire yourself, today. And that's like,
and you have to have patience. Right. You have to have patience as a virtue instead of keeping money in flow. And I think that's okay. So let me ask you a question. So, over the last year, obviously when we did the interview before, the Wealth Elevator book was not in mind. Right. So what have you learned over the last year? That while you're writing the book, like, did something surprise you in it? Because you mentioned something about taxes, right? About tax implications, tax strategies, those types of things. What did you learn over the course of writing the book or over this past year that you want to share with all of us that was a surprise to you?
Yeah, I mean, I kind of call this the bucket theory, where and I kind of just mentioning this, like, the idea is you fill up one bucket and you let that bucket fill up the next and then fill up the next. And a lot of like my clients, when they come in, they've kind of been doing it the wrong way, where they follow directions and they invest in the 401k, the 403b, or whatever they have right at their job. Or they do their Roth accounts or IRAs on their own. Unfortunately, I think this is the second bucket you fill. Right. The first bucket is filling up your today cash flow bucket, which means, buying other assets such as rental properties or getting involved in syndications. So you start to build a cash flow stream today. And then not only until you get maybe to $15,000, $25,000 per month, then you fill up that second bucket, which means then you go and fund your 401ks, your Roth IRAs at that point, because that second bucket, it's a retirement account. It's more legacy type of money that you give to your kids and you don't really need to spend it. Right. And that's kind of where, if you're able to concentrate your focus on building that today cash flow bucket, you're going to get to financial independence quicker. And then the cool thing is once you do that, then it fills up the second bucket a lot quicker. But as I mentioned earlier, when you spend, you've got half of your money going to your 401k and the second bucket money, it never goes and fills up your today. And maybe this is some strange way society has created to not have us ever invest or never get to financial independence because we're too busy focusing on two buckets. Maybe that's a byproduct of it.
And too busy focusing on, creating wealth for the future, which is such a long way down there. And it doesn't, how many people have you talked that are, equity rich, cash poor? 401k rich, cash poor. And, the adage of I need to have an emergency fund. Notice that for those watching, notice that you didn't say an emergency fund, you said today cash. And the thing about an emergency fund is if you have the today cash, if that passive income is coming in like clock, I used to call it mailbox income, I now call it inbox income, right? Where you have the money coming in, the flow coming in, you don't need an emergency fund. You never need an emergency fund when you have that perpetual income coming in. And so I think that you bring up a really, really good point, is that we need to get ourselves in a position to have that passive income sooner. Now, it's interesting. I want to ask you another question. Your elevator, process here. One of the things that I've been sharing with my coaching students is with nominal cash investment, there's opportunities as a non-accredited, and I know you work with accredited, but there are non-accredited avenues of $10,000 minimum to go into a crowd fund to hold notes to receive monthly passive income. Tell us about your opinion on that, as opposed to having the $10,000 and keeping it in the bank account at 1 or 2% until you have 20,000, until you have 30,000, and buying that first house. Tell us about the opportunity cost, loss, etc., loss cost or advantages of maybe investing in some notes in the short term when you're not an accredited investor, instead of saving for real estate in today's market specifically.
Yeah, I mean, I guess it kind of comes down to like good, better, best, right? Like I'm all for people beating kind of what they're getting in the stock market, traditional investments, where the big institutions are essentially stealing your money blind with all these hidden fees. Notes, you're going to get maybe high single digit, mid single digit returns. And, it's like even syndications and private placements, you can be investing on the equity side or the debt side. The debt side being a little bit more reliable, higher on the capital stack, but little lower returns, right? You don't have that upside you have with the equity side. And in my opinion, and I think, when you're starting out, when your net worth is under $1 million, even $2 million, $3 million, you need to get on the equity side. You need to get after it. You need to take a little bit more risk to get those returns, 12, 15% plus per year. And that's when you need to be kind of taking the chances. What I talk about in the wealth elevators, when you start to get past maybe 2.5 to 4 million, certainly when you've hit 4 to 5 million, 4 to 5 million is what I call end game. The reason being is, you take 5-10% of 4 or 5 million. That's enough for most of my clients, at least, to be financially free at that point. And then you don't need to take as much risk. And of course, your net worth continues to rise, but it doesn't need to grow leaps and bounds as it does when you're under $3-4 million net worth. So as you mentioned, or like the notes, they're great, but it depends on where you are in this wealth building journey. If you're under that threshold net worth, I would say you need to find more equity types of deals. And then, another reason why I don't like the retirement plans, and this is counterintuitive of what everybody thinks. Retirement plans, they think tax savings, but you're going to have to pay the taxes at the end anyway. Whereas by investing in cash, you get all these tax benefits, such as the depreciation and losses, to either negate the taxes that you're paying on the income from that investment, or possibly use those tax benefits somewhere else in your personal profile to negate taxes there. And that's the big game changer.
Yeah, I love that. And I was going to ask you, and then this will be our last couple of questions, but I was going to ask you, whether age has a play in this, because, when you said you got to take on more risk, more, as you get older, you just don't want to take on as much risk. And I think that there's probably some kind of a teeter-totter there of, foregoing risk to have some gain rather than having a whole bunch of gain. I think, and you come from the perspective of being a younger person who says, look, now's the time to take all the risk. I think age has a play in this, definitely. I think the other thing I just want to point out too is that, reaching 2.5 to 4 million in, net worth for some people is something that may never happen because of where they're at in their job, right? Or maybe they make a lot of money, but have a bunch of kids and they have college education, whatever it may be. Can you share with us your definition? So speak to the age situation. And then the second is your definition of financial freedom, because you mentioned that you have financial freedom at 2.5 to 4 million. I have to say that I disagree. I think financial freedom is when your passive income exceeds your the cash needed in your daily life. So if you have a lot of credit card debt, you need more financial freedom, right? You have to have more value in order to compensate for that. But if you don't have credit card debt and and your house is paid off, right? All you have is the ancillary. So you're financially free with a modest $4,000 or $5,000 a month in passive income. It doesn't have to be, tremendous, but I want your take on that as well. So let's talk about age and let's talk about that financial freedom breaking point.
Yeah, I mean, as far as age, I don't really care how old you are, right? To me, your net worth is your age, right? It's just strictly numbers. That said, when most of my clients are kind of in their 40s and 50s and, family of four in California with 2 kids, right? So that's kind of where I base my normal 4 to 5 million net worth. That's typically enough for these guys to be financially independent. And I totally agree with you, right? Like that, it's not the net worth number per se, but it's the cash flow per month number. Yeah. But a lot of times my clients, especially when they're getting started, they don't know how to turn money into cash flow. So if we have to start upstream with them a little bit and like, dude, your net worth is 2.5 million. You're pretty much knocking on the doorstep of financial independence, even though you don't have any real or non-traditional investments. We just have to, convert it to cash flow for you. But
right.
As we have some clients who live in Alabama that are single or have kids that are gone through college and not really a liability anymore financially. For some of those people, that net worth could be $2 million or even $1.5 million, like you said. Or if they're very frugal, they could live off $5,000 per month, especially if they paid off their house. Of course, if their net worth is lower, they probably want to use the equity in the house to continue to grow it. But, the whole point is you kind of understand how money works. And it kind of sounds like you guys talk about the same thing too, in a way. But, that number, that net worth number comes down as you age or your how big your lifestyle is. And it's something we did at our last retreat. We lined up everybody in terms of their burn rate, right? What is their monthly expenses? We've got some younger guys, we call them Henrys, the high income, not wealthy yet, big crowd. And most people are in their, right. 40s and 50s, like I said. Some people are a little bit older too, but not anybody had a monthly burn rate of 20 grand per month. So,
right.
We're not, at least our investor group, we're not, Ferrari driving, crazy millionaires, even though we are millionaires. But,
yeah. Well, and it depends on what, your definition of success is. Some people, for them, driving Ferraris is the ultimate success. For me, the ultimate success is dropping everything today and going and spending time with my grandkids because my business can survive without me sitting in front of it. And I think that's a key thing too for people to be thinking about is what is your definition of success, not everybody else's. I was on a podcast recently and they said, well, what was success when you were younger? And I go, owning a Mont Blanc pen. That was like the thing. If you owned a Mont Blanc pen, you'd made it, right? Or if you're driving a BMW, which I would never even drive now, right? But it was so important that you had the Mont Blanc pen and you were driving a Beamer and saying Beamer. What is the definition of success? Until I realized, wait a minute, that's not my definition. That's somebody else's definition. And I think that's a key critical component of this. People are thinking, what is my penthouse? Is my penthouse at 100 and something stories, or is my penthouse at 8 stories? It's a different penthouse. It's still a penthouse, right? Yeah, so I love that you're talking about that. Yeah.
But what we do know is that goal is probably some multiple of $1 million, couple $1 million, right? Net worth and a cash flow stream
of course,
5 figures. And I think for young people who don't have any clue what that is, what you just gave is a better direction than being complacent. I think where most people are, where just invest in your 401k, do it for 40 years. That's just never going to get anywhere.
And everything will be great. Yeah, it doesn't get anybody anywhere. I love it. I love what you're doing. I cannot wait for your book to come out. I cannot wait to have the opportunity to read it. And hopefully I'll get an opportunity to get a good testimonial for you too, because that'll bring in some more people. I love it. So let's leave with this. What do you want to tell someone who's saying, okay, I love what Lane is saying. What is my next step? What do I need to do to connect with you, to attach myself to you, to learn from you, to contact you? Or what is my first step before I call you? Do I analyze what I have? Do I what do I do? What do I do? What do you say to someone who's watching and saying, here's what you do. Here's step one.
Yeah, what I would say, if you're listening to podcasts, check out my podcast, The Wealth Elevator, or you can Google Simple Passive Cash Flow is the one we rebranded from. My email address is lane@simplepassivecashflow.com. And then, if people want to kind of join our website, join our group for free, then we have all the past coaching calls that I've done. And what people tell me is like really useful is like, you find where you are in terms of net worth, and you kind of start, we arrange them all by net worth, and you start watching them, and you can kind of see the same themes developing. But once the book comes out, it kind of teaches it more academically, but, or I guess do both, right? Like kind of learn just kind of by what are kind of the teachings buried within those hour-long coaching calls, because it's a lot of the same themes being pulled out.
Right. And that's at thewealthelevator.com.
Yeah, that's correct.
Okay. Yeah, you didn't get to that. You were like, go to my website and there you can learn. I want to make sure we got the name of it. So that's awesome. Well, thank you again, Lane, for coming in. I love that you're progressing. I love that you're moving the needle on what you're doing. And, it sounds really cool. It sounds so condensed and easy to understand. I love that you're doing that. And, I just wish you the best. And I hope that we will continue to, I know I'm going to go there. So I hope that we will continue to, communicate over the next several years. And please let us know what we can do to help you promote your new book when it comes out.
Yeah, we'll do it. Thanks, Jen.
Yeah, absolutely. So thank you, everybody, for joining us at Beyond the Podcast. And we hope that this information has been helpful for you to be able to move the needle on your wealth building process as well.